Hi, I'm Durga. We would like to present on the IGM Plantation Berhad. Okay, basically IGM Plantation Berhad is a company engaged in plantation and investment. The major shareholder, IGM Plantation Berhad's major stockholder is IGM Corporation Berhad with 55% shareholding. Other institutional stockholder, which consists of about 12.16% as per the table here, and they are the top 10 substantial shareholder. And Kumpulan Wang Persaraan is holding 4.73%, followed by Public Mutual Berhad and etc. IJM Plantation Beta is 0.97, indicating the company more volatility, whereas the higher the beta, the more gain when the market is up. The market risk basically on the foreign currency risk, as the group is primarily transacted in other currency for certain borrowings. And the second thing is commodity price risk, where the commodity price are very high, highly volatile. Uh, Second is liquidity risk on the borrowing or lending within the group company. And the capital risk is based on the adjustment of the dividend payment. Investment return. Basically, the company have three ongoing projects, which is a new palm oil mill in Indonesia, which aimed to get a payout on 2019. Second is PT Perindustrian Sawit Synergy, expected to get the gain by March 2018 has been entered and will be expected getting gain by 30 million. A third is Young Palm Profile in Indonesia, where the weighted average age is only 6.8 years for its Indonesian estate, and the growth in production will contribute from it as the plant continues to mature in future. Capital structure. IGM Plantation have a total debt to equity. Total debt to equity is 61.74%, and for every RM of IGMP owned by the shareholder, IGMP owns 0.62 to the creditors. Low debt to equity could be due to the industry is low capital industry and may attract more investors because their interests are better protected in the event of a business decline. IGMP total debt to total asset ratio is 42.16% or 0.42, indicating that the greater portion of a company asset is funded by the equity, about 58% financing with equity. Debt financing. For debt financing, the advantages are maintaining ownership, whereby the debt financing gives complete control over business. Tax deduction. Business loans are tax deductible. Retaining profit. Do not share your business profit with the lender. The disadvantage is the repayment, whereby we have to ensure the business can generate enough cash to service the debt. On the credit rating, if we fail to make the repayment on time, it will affect our credit rating. On the dividend policy, directors declared a single share interim dividend amounting to 5 cents per share. And basically, we would advise IGMP to return the excess cash via dividend payout to the shareholders and for a better return. Because when we pay more dividend, then there will be more investor attracted to the company. The growth pattern of the firm for the past 5 years is illustrated for the table here, and the pattern is not promising looking at the negative financial indicator. Basically, the declining trend of revenue is due to the crude palm oil sales volume, lower commodity prices, and higher production costs from the increase in the young matured areas in the plantation division at the Indonesian operation. Furthermore, it is also compounded by the net unrealized foreign exchange losses of 22.6 million in US dollar denominated borrowing compared with 8.5 million recorded in the same quarter in the previous year. Basically, the growth pattern is viewed will be improved in future based on the 61,000 hectare of planted area in Sabah, Kalimantan and Sumatra, which is valued at the recent transacted price in Sabah of 65,000 per hectare and US 10,000 per hectare for each Indonesian estate. Planted area should be worth 3.04 billion or 33.47 per share, could represent share price upside of 54% or implied financial year 2019 PE of 37 times. The market value of the equity of the firm stood at 1.276 billion as at 24th March, and based on this, we can expect it for higher value if the closing price is higher. The cash flow of the business, how to improve the cash flow is by considering increase the sales and lower expenses by analyzing the process and look for ways to increase operational efficiency by cut costs and control inventory without affecting the operation.
Hi, I'm Sharmila. Now let's look at the analysis on firm's financial position of IGM Plantation Berhad. Profitability ratios measure how effectively management is generating profits from corporate assets and from firm investments. IGM's gross profit margin decreased from 0.39 to 0.31 in the year of 2018. This shows that the firm is making less money from each sale, therefore it might be less stable. Operating margin is also known as operating profit margin. This ratio shows what percentage of total revenues is made up by operating income. IGM's operating margin ratio decreased from 0.26 to 0.17 in the year 2018. A lower ratio means that this firm is less efficient in making enough money from its ongoing operations to pay for their variable costs as well as their fixed costs. Next, net profit margin is the percentage of revenue remaining after all the expenses are deducted from the company's total revenue. For this, the ratio went down from 15.46 to 5.9. When a company's net profit margin declines over time, this means their sales are decreasing or they have inefficient expense management. ROA, or return on total assets, is a ratio that measures how well a company is using their assets to generate profit. IGM's ROA decreased from 0.04 to 0.02. This means that the firm is using lesser of their assets to generate profits. The return on equity ratio is a measure of the rate of return on investment. This ratio has decreased from 0.07 to 0.03 for this firm. This shows that the firm is less effective in reinvesting their capital. Next, let's move to liquidity ratio, which is defined as ability of a company to meet its financial obligations as they come due. IGM Plantation Berhad's current ratio decreased from 1.87 to 1.11 in the year of 2018. Higher numbers are favorable, which implies that the firm has higher amount of current assets when compared to current liabilities, and they should be able to pay off their short-term debt. Asset management ratios are a set of ratios that measure how effectively a firm is managing its assets. Asset management ratios include inventory turnover, fixed asset turnover, and daily sales outstanding. The firm's inventory turnover ratio has increased from 147.21 to 203.43, which is favorable as it reduces storage and other holding costs. Their fixed asset turnover, however, increased slightly from 0.52 to 0.53. Higher the fixed asset turnover ratio, the more effective the company's investments in fixed assets have become. The next ratio is days sales outstanding, which represents the average number of days it takes credit sales to be converted into cash. This ratio has also increased from 0.75 to 1.41. This is not favorable as it indicates inefficiency in credit sales collection.
Sunderby plantation is involved in the full spectrum of the palm oil value chains. Its current operation comprises production of oil and fat, biodiesel, other palm oil, derivative and renewable, as well as the sale and marketing of this product in 16 countries. Sunderby plantation business philosophy in the manufacturing of comprehensive range of palm oil based product is to maintain the highest quality of all time. This has ensured the company and edge its selling prohibition in Sunderby plantation apart from the competition. More Sunderby plantation operation in Malaysia have a total land bank of 300,000 hectare with all palm planted area of 303,000 hectare, which is 83 in mature. In Malaysia, Sunderby own and operate 124 oil palm estate in the Peninsula Malaysia, Sarawak and Sabah, as well over 11,600 hectare of rubber plantation in the state of Kedah, Perak, Negeri Sembilan and Johor in the Peninsula Malaysia. So in the Sunderby, they have a risk and return. So inside the risk and return, they will include the market risk. So what we can see from the market risk is the foreign currency exchange risk. The group is exposed to the currency risk as a result for the foreign currency transaction entered by the group. The group and the company revenue were translated into the following currency such as Ringgit Malaysia, United States dollar, Indonesian rupiah, European Union euro, Thailand baht and others currency. So beside that, they include the commodity price risk. The group and the company entered the commodity future contract to minimize exposure to adverse movement in the crude palm oil prices. Certain contracts are entered into continue to be held for the purpose of the receipt or delivery by physical commodity in accordance with the group and the company expected purchase, sale or usage requirement. Contracts that are not be held for the purpose of physical delivery are accounted for as a deliveries and disclosed. So next will be the liquidity risk. Liquidity and cash flow risk that the group or the company will encounter is difficulty in meeting financial obligation due to the shortage of fund. The groups and the company exposure to the risk arise primarily from the mismatch of maturities and financial assets and liabilities. To mitigate this risk and to an acceptable level, the group maintain a sufficient cash and marketable securities and include the commodity price risk. The group and the company entered the commodity future contract to minimize exposure to adverse movement in the crude palm oil prices. Certain contracts are entered into continue to be held for the purpose of the receipt or delivery by physical commodity in accordance with the group and the company expected purchase, sale or usage requirement. Contracts that are not be held for the purpose of physical delivery are accounted for as a deliveries and disclosed. So next will be the liquidity risk. Liquidity and cash flow risk that the group or the company will encounter is difficulty in meeting financial obligation due to the shortage of fund. The groups and the company exposure to the risk arise primarily from the mismatch of maturities and financial assets and liabilities. To mitigate this risk and to an acceptable level, the group maintain a sufficient cash and marketable securities and the ability of funding through an adequate amount of committed credit facilities. The group maintain centralized treasury. And lastly will be the capital risk. Disciplined approach in the capital allocation and the cash flow management optimize our capital structure to ensure the competitive cost of capital, which include balancing debt, equity level by putting into place appropriate dividend and financing policies. Maintain strong financial policy position for ready access to a capital market. Next, we focus on the capital structures of the Sunderby Plantation. So, as we can see, the group borrowing at 30 June 2018 is 6.5 billion, was significantly lower by 2.8 billion compared to a year ago, arising from the result of the pre-listing internal restructuring of SDB Group, early repayment as the bank borrowing and redemption of USD 49.6 million of the multi-currency sukuk in February 2018. So group borrowing position, bank's financial institution previous on 2017 is 7,737,000, and then 2018 is 6,489,000. So we see the different around 1 million. And then we can see from the total debt is on 2017, the total debt is 61.5%, compared to 2018 is only 39.8.
Hi, my name is Farhana and I will discuss about the analysis on firm's financial position of Samdabi Plantation Berhad. On profitability ratios are being used to measure and evaluate the ability of a company to generate income or profit, which is a way to measure a company's performance. As for gross profit margin, we can see that Samdabi Plantation has higher efficiency of core operations in 2017. On ROA as well, more effective in 2018, deploying their assets to generate more revenue and profit. Liquidity ratio is measures to see their ability to meet its short-term financial obligations. If the ratio is too low, it indicates that company is not able to pay off their short-term obligations, or if the ratio is too high, means the company is not utilizing its cash efficiently. As we can see in the table, 2018, the ratio was much higher. Investors use leverage ratio to determine whether the company's debt level is sustainable or vice versa. It is used to determine the level of debt load that a business has incurred. In 2017, it has higher debt ratio. Asset management ratio is to measure the company's success in managing its assets to generate sales or revenue. The higher fixed asset turnover by 2017 shows that their sales or revenue is higher than 2018. Let's quickly compare the ratios between IGM Plantation Berhad and Samdabi Berhad. The gross profit margin for IGM is higher than Samdabi. IGM has a ratio of 0.23 while Samdabi has a ratio of 0.14. However, in the operating margin ratio, Samdabi's ratio is higher than IGM. Samdabi's ratio is 0.42. The net profit margin of Samdabi is higher by 41.79. The return on assets of Samdabi is slightly better than IGM. The ratio is 0.09. The same goes to return on equity, as Samdabi's ratio is slightly higher than IGM's ratio, which is 0.14. The liquidity ratio, which is the current ratio of Samdabi, is also higher than IGM's, which is by 0.60. However, the debt ratio of IGM is higher than Samdabi's, which is 0.47. IGM also performed better in regards to the debt to equity ratio, which is 0.88. The inventory turnover ratio of IGM's is also better than Samdabi, which is 39.29%. But however, the fixed asset turnover of Samdabi's is better. The total asset turnover of IGM's is better by 1.07, but the daily sales outstanding ratio of Samdabi it's better than IGM. The ratio is way higher than IGM, which is 26.8.